Take us through like a journey, but in a very brief of what microfinancing has been in Nigeria, what it used to be, what it is presently, and what are the peculiar challenges facing microfinancing in Nigeria.
Thank you very much. We've really come a very long way as a country in terms of microfinancing, micro lending, and the likes. I mean, we've come from a time in the past, many years ago, when lending was strictly done informally, and it was largely between unions, market women, and influencers within the society who would rally trade individuals, professionals. They will rally them round, collect monies from them, what is now called cooperative, or just provide loans, and then they used to call them either Babalajo, Mamalajo, or people who even they don't collect ajo, they will give you loans and they will go to your door to door to obtain those loans. So we have since evolved from those days to days when our banks were just very small, and then British banks came up. Then there was the Nigerianization, and then large banks who were not very, whose fundamentals were very weak. But today, what we have now is we have tiered banks, right? We have international banks, in Nigerian international banks, that have very large capacity to provide funding. We have microfinance banks. So we have international banks, we have regional banks, still commercial banks. Then we have microfinance banks. Now, in the microfinance banks, you have units, you have regional, you have national microfinance banks. Then you now have lenders. Those are what we call micro lenders. Those ones are licensed by the state government. That's where technology is helping to drive greater inclusion and penetration of micro lending and microfinance. A lot of our microfinance entities today and our micro lenders are now adopting technology to drive it at scale. But there are also challenges there, as you did ask, and one of it is the pervasiveness of loan sharks, because as technology is a good thing, is the same way there are disadvantages to it, because loan sharks are lenders who, and a lot of them, without trying to stereotype, but if you go on Google, you will find that a lot of them are Chinese built applications. So what they do is they lure you to take a loan from them. The rates are way above regulatory standards or regulatory allowances, and then they continue to harass you, such that you either take more loans or you are unable to pay back, and then they break all the laws to get their money back. They reach out to your family, so these are the biggest challenges. Then another major challenge, especially for the SME space, because I am an SME person, is that majority SMEs are still not qualified to take some of these loans. So we see that, yes, we are solving a lot of gaps in terms of availability of funding options, but we're still not addressing at scale. Don't get me wrong, a few people, many startups now are addressing it, but we're not addressing at scale the fundamental challenge or finance issue that is happening with majority of our populace because of the nature of our economy.
Okay, I'm going to ask you two questions in one. First of all, let's understand the objective of the microfinance institutions. You mentioned different kinds of microfinance institutions, loan sharks, lenders, and all that. But let's understand the core objective and their target, because you also mentioned that some SMEs are unable to obtain loans or unable to have access to what the microfinance institutions bring. So let's know the objectives and then the target, the requirements that will enable the targets benefit from what they bring.
Okay. So when you say objectives, usually the objective of a microfinance bank really is to provide funding to those at the bottom of the pyramid. So micro businesses, informal businesses, small scale businesses. That's why you see them a lot within the markets and places like that. So that's their primary objective, right? But don't get me wrong, I didn't say loan sharks are a type of microfinance. No, I said loan sharks are those who are doing micro lending illegally. And because they are doing it illegally, they then break rules, stifle people's livelihood, and give them loan rates they exploit the situation and give loan rates at ridiculous interest, such that you are unable to pay back, and you continue to pay them and you are stuck to them. Now, so different categories, commercial banks, really the objective is to stimulate liquidity in the economy, right? They deal with larger tickets, larger balance sheets, larger transactions, and all of those kind of things. So that's their primary objective. All of them in the banking ecosystem have one single objective: to make interest income, right? Now, but the dynamics of the banking space is that because of the cost of capital and their total, the nature of their transactions and regulation and all of that exposure, their requirements are too complex for small businesses or individuals who run at informal level, right? So if I produce biscuits, for example, at a small scale, maybe I've not even registered my company yet, or whatever the case may be, I find it difficult to deal with a large bank, a tier one bank. So microfinance banks' objectives is to address the needs of such individuals, at that level, people in the markets, right? People in the, people who do business on a smaller scale. So still the same objective of interest, but in this case now, specifically addressing those in the smaller echelon of the market. So that's the objective. But the objectives of the illegal ones is really to exploit the economy, give you loans at ridiculous rates such that you can't pay back, or you are unable to pay back, and then they begin to hound other things that you have.
All right. Ideally, microfinance firms are supposed to provide financial services to the poor, or let me use the word, those who are not being banked traditionally. But you discovered this day that even microfinancing are clashing with commercial responsibility. What is actually wrong? Why do you have this clash of interest? And then are they still living up to the concept or the ideal model of microfinancing as it's supposed to be?
Okay, so I think that this is what regulation is also trying to catch up with, right? So this is the way it works. The truth is that in as much as there are initial expectations, but what then happens is that with the use of technology, there is really no boundary to, or no limits to, my coverage in terms of customer size or assets or all of that. However, I wouldn't say that a microfinance bank is technically allowed or technically able to play like a commercial bank, because as a microfinance bank, your capital size is still limited. A lot of times you may have a single obligatory limit that is lower than that of a commercial bank. There are some types of transactions you may not be allowed to do. So they are still significantly different from each other. But yes, I do agree that with the use of technology, they are able to reach a wider mass of the market size, as they would not have been able to do in times past. So we have a few banks, I will not mention their names now, who are running on microfinance license, but they are almost playing at scale of a commercial bank in terms of coverage and user base, customer base, and all of that. But in the terms of types of transactions, I don't think that they are doing the same thing. I think that there's still some sort of difference, remarkable difference between the microfinance banks and the commercial banks.
Okay, let's talk about lending rates. What's really or ideally should be the lending rate from microfinance banks to borrowers?
Okay, so there are different dimensions to lending rates. So there is lending rate from the CBN. If if you are a microfinance bank, or you are a commercial bank and you are regulated, or you are a finance house and you are regulated by the CBN, you would have to keep your rates to the policy rates provided by the CBN, which is usually between 25 to 30% on an annualized basis, right? If you are a lender, a micro lender, meaning that you are regulated and licensed by state government, for example, Lagos State government, the maximum annualized rate you are allowed to charge is supposed to be around 48%, between 40 to 48% annualized charge. If anything goes above that, it is already moving into a loan shark territory. So usually what a lot of people do is that they then they commoditize, or if I can, they unbundle the annualized rates, and then the micro lenders and microfinance banks are then able to give you rates. They are able to give you rates that on a monthly basis. So I can give you money that you pay back in 2 months, 3 months, and in that 2 or 3 months, I could charge you maybe 5% every month or 4% every month or something like that, right? That will still be within the 48%, 50% maximum markup. But if I now start giving you at 15%, 20%, 10% every month, then that is getting ridiculous, right? And that is then moving into loan shark territory. So those are the general rates that apply. There's also the option of the debt capital market. Of course, most times small, micro businesses are unable to access that, but a few times medium companies can. A few medium companies can. You could do private notes. You could do commercial papers and all those kind of things. Those are also debt instruments, right? But they are a lot more stringent in terms of requirements, and the interest rates are usually generally lower. In fact, you could get single digits, you could get 15%, you could get 18, you could get, it depends on what your advisors structure, how they structure the facility, and those who buy into that facility.
All right, the economic reality now has suffocated some microfinance banks, and they are gradually going out of business due to some of the challenges. I would like you to talk to us some of the challenges being faced by these microfinance banks and this, obstacles associated with microfinancing in Nigeria.
Okay, can you help me take that again quickly, please? I'm not sure I got you at the earlier part of your statement.
I made reference to the challenges being faced by microfinance banks in Nigeria, which is some of them are going out of business due to the economic reality. So the question is, talk to us about these challenges that has to do with microfinancing in Nigeria.
Okay, thank you. Thank you very much. So I think that one very crucial challenge facing the microfinance space in Nigeria is regulation. I think that there is a lot of innovation that is happening in that space, that regulation, especially over the last 8 to 9 years, has sort of stifled under the previous CBN governor. There's a lot of progress that we should have made that I personally believe that we did not make at that time, simply because of, stifling regulation. I'm hopeful that things are going to get better now, especially since we have quite a bit of technology ecosystem enablers right in the thick of government. I think that the number 2 challenge is the cost of capital. So the thing about economics is that as your macroeconomic indicators, get worsened, your sovereign rating, begins to reduce, and then it affects ability of institutions to raise capital, be it debt or equity from the international market. International market usually has the lowest cost of capital. Individuals who are also providing it locally are afraid of their economy. So a lot of people are thinking of channeling their funds to other places. So people who would ordinarily give their monies to a microfinance bank to help them, trade and give them returns would maybe think of other options, right? Just to make sure they are safe, right? You also have a lot of people who are immigrating, and this is not people. A lot of time, people misconstrue immigration issue as something that for the bottom of the pyramid population, but that's not true. It's mostly those in the middle class and the upper class that are moving, and these are the guys who provide liquidity to the financial institutions that they then in turn give as loans. So that's another big challenge, right? And the largest challenge ultimately is data availability, data adequacy. Loaning and credit and financing is extremely tied to data. I have to know where you live. I have to know where you work. I have to know, your behavior. I have to know your driving pattern so that you don't die with my loan. I have to know that you have dependents and siblings or guarantors who are able, and they are valid, they are verifiable, who are able to repay if anything happens. I have to know that your salary is your salary and that your company will pay me back. So there's a lot of data dynamics that does not exist in this country. We don't know when we are born. We don't know when our people die. We don't know when people leave. People submit an address at the bank, and the next year they've moved out. Nothing compels them to update those addresses because our postal system doesn't work. If we had an efficient postal infrastructure, you'll be compelled to update your addresses because you need deliveries to come there. But in Nigeria, we don't have that, right? And because we don't have that, it means that creditors and funders cannot harness the data set from our logistics infrastructure or any other infrastructure, right? So these are the biggest challenges. And how do we begin to solve that? I think that in the absence of data, funders, microfinance banks, government, and any other person who is interested in addressing the SME ecosystem needs to start speaking and working with clusters, right, and aggregators of these SMEs. And that's what the tech ecosystem has been able to do very well. There are some people who are, they call them accelerator programs. They are like the sources or I can call them the pipeline. They generate the pipeline of viable businesses and viable startups that funders then give money. And I think the same thing should be replicated in the SME space, right? In fact, it has been replicated, just that government and funders are not harnessing it enough. That's in the absence of data. At least these aggregators know them, they know where they live, they've been doing business with them, right? Now, in the long term, government needs to start solving for data challenges, infrastructure challenges. If you fix our rail, if you fix our power, it will drive down costs, it will drive down unnecessary taking of loan to finance infrastructure that government should be providing, when they should be taking the loans to finance production, right? If you also fix the delivery NIPOST, right, it will mean that every Nigerian would have their data in terms of addresses with NIPOST, and then other infrastructure, other service providers can then leverage the data bank of NIPOST to deliver services as best and as confidently as they can. Even interest rates will now reduce because risks will reduce, right? And there's always a chain effect of these things overall on the economy. I hope I've been able to address that.
Okay, let's look at the side of the borrower. A lot of people still turn to loan sharks. What is that thing about loan sharks that makes them attractive to people who need capital, in spite of how much they've seen people who get money from loan sharks embarrassed? But a lot of people still subscribe to using loan sharks. And how does this thing of having so many loan sharks out there impact SMEs and even the economy?
Okay, thank you very much for that question, right? So, look, it's a case of demand and supply, right? There is a huge market and need for credit in this country, especially quick credit. Quick credit, that's the word. A typical legitimate organization, with legitimate borrower would do KYC. They would ask you for a lot of things. They would take their process. Now, these days, you have fintechs who are doing it in 48 hours. Loan sharks most times are able to do these things in less than an hour. You populate immediately, they deploy, and then you just click on agree here and there. You don't know that they've already pulled your data, your phone log, they've pulled a lot of things from your phone, which is against NDPR regulations. But they are sharks anyway, so they are not interested in complying with the law. So when you take those monies, their strategy is to hound you till you pay back their ridiculous loans, their ridiculous interest rates. Yes, ordinarily people should move away, but look, if the demand is massive, people will exploit it. If once you create a vacuum, a vacuum, what's that thing that they say that a vacuum harbors, I can't remember what it's called, but once there's a vacuum, it has to be filled, and that's what the loan sharks are doing, and they are also leveraging the ignorance of majority of our populace about financing and financing options. And that's why I'm happy with what you're doing, and I think a lot more of us and media organizations should provide a lot more education and funding and options on how to identify loan sharks.
All right, like you said, reason most people fall victims to loan shark is because of the easy access to loans. They can disburse loan in 1 hour within 24 hours. Now, how do we begin to address this issue of bottleneck that has to do with, accessing loans, especially for SMEs who need small loans to survive in their businesses? Then also the other side to it is, how do we address this issue of loan defaults, people obtaining loans and then they have this inability to pay back?
Okay, so I think that the burden of ensuring that a company can pay back, or that an individual can pay back, is on the lender. It's you that will do your due diligence to first ascertain. I mean, we have clients in Caladium Consulting that engage us to just help them do a DD on some of their customers, just to know if the business they want to take a loan for is viable, and if they will be able to pay back, right? Not just pay back, if after paying back, the business will still be able to run, right? So, I mean, that responsibility really lies on the lender. So you should be checking for their credit records. You should be checking for the validation of their KYC information. Do they live where they say they live? Do they work where they say they work? Do they do business where they say they do business? Is a business registered? Is it active on CAC? Because a registered business is even an active business, right? So all of those elements of due diligence, is the responsibility of the lender. It's not the loaner that is going to be doing all. It's not the person that is taking loans that is going to be doing all of that. Now, in terms of default, the truth is that you see, there has to be incentives, or if I can call it disincentives, for default. As so far as we continue to create an incentive environment for default, we're still struggling with challenges of default. But I also like to tell my friends in the finance industry that our default rates are not as high as we always paint them to be, especially amongst the SME spaces. If you go and meet the best microfinance banks that play in the SME space, their turnovers and their returns and their recoveries is mind-blowing. SME owners always pay back. They pay back because they know their shops, they know their markets, they interact with them, they collect their monies on a daily basis or on a weekly basis. So you need to understand, if you want to solve defaults amongst SMEs especially, you have to first relax and understand their dynamics. An SME is not a salary earner. An SME is not a big company. So his dynamic is completely different. What type of business does he do? Is he a daily cash flow type of business? If it's daily type of business, it's better to structure your loans for daily collection. If it's a business that can pay you weekly, you structure it to collect it weekly. If it's one that can pay you monthly, you structure it to collect it monthly. But you don't do a blanket approach for credits across different segments, right? It may boomerang, because the businessman who thinks he will be able to pay you may still be able to pay you, But because of the nature of his business, he may have spent the money he wants to pay you today, and he's stranded again for another 3 days. So you need to better understand his business, and also do not give loans beyond what people need, because a lot of times people also do not just need the money, they just want to take money because it's available. So they are coming to me to take a loan. Why would I take the loan, right? So if there is no clear-cut business case and justification and viability for loaning anybody money, there's really no point loaning anybody money just because you want.
All right, I would like you to still address the first part of my question, and I'll rephrase it again, which is, how do we address this issue of bottleneck that has to do with, assessing loans for SMEs? If they need to get loans now, the requirement is scary, it's not easily available. The things you'll be asked to bring, and so it discourages a lot of SMEs from obtaining loans. So how do we address this bottleneck to make it easier for SMEs?
Okay, so I think I did mention it, but maybe you missed it, right? So let me explain it. Number one of the biggest reasons why SMEs do not get loans, why they are bottlenecks, is that SMEs, about 75 to 80% of SMEs play in the informal space. Now, what it means is that they are not registered, they do not have documents, they do not have bank accounts, they do not have access to data, they don't have that data or documentation that financiers or banks or MFB, microfinance banks, require to give you a loan. So by design, they are already excluded from the formal funding system, right? So the second leg is that for some who even are in the formal lending system, they don't keep sufficient records. There is no historical database or record, financial information for the funder to use as a basis to give the loan. So again, number two leg, you have excluded yourself again, you have made yourself unqualified, right? Now, which was what I then said, that to solve this problem, we have to work with aggregators and accelerators of SMEs. So, and let me give you an example. We run a community called Caladium Lagos SME Community. On November 4, we'll be running our boot camp, the 6th edition of Lagos SME Boot Camp. And what we simply do in those places, at our boot camps and in our community on a daily basis, we help businesses structure their business. We teach them pro bono. This is how to keep your books. This is how to build your brand. This is how to increase the quality of your product. This is how to effectively utilize loans. This is how, so we teach them all of those things and we watch them journey. Now, a few microfinance banks or operators in the finance ecosystem would usually come to us to say, guys, I want to partner with you so that I can provide funding to any of your community that you have vetted that are credible enough. So the credibility, we will now be like the guarantee backing for. So it's like an accelerator where you have helped them go through a process. You are then presenting them for qualification for credit facility. That is on one leg. I now said that on another leg is that government on its own embark on a mass transition of those in the SME space into the formal space, the informal SME space into the formal SME space, and then still also engage a few SME professionals and consultants and enablers to now manage and support all these SMEs and prepare them for funding. So the biggest obstacle is just preparedness for funding. That's the thing. If you are also a bank, you are not going to give your money to somebody that doesn't have all the required fundamentals, because you also have to report to your regulators. So that's exactly what the issue is. And if you don't solve for that, you just wouldn't have enough SMEs that are qualified to take loans.
Cooperatives for savings and loan purposes. A lot of them are emerging now. Some are even transitioning into microfinance institutions and offering interest on deposits as high as 7%. How they're able to sustain that, I really do not know. But should we be looking at strengthening those cooperative societies, because they seem to be closer to the SMEs, and they have some SMEs as part of them who are also depositing money, because the formal financial system seems somehow complex for maybe a lot of SMEs.
Oh, awesome question that you just asked me. You see, we are a licensed. We have a licensed cooperative society, for example, that supports our SME community, and cooperative societies have been in existence since time immemorial. As a matter of fact, cooperative lending, we call it peer-to-peer lending, in the informal space is the biggest provider of credits and savings scheme to those in the SME space. And very brilliant question, because that feeds into my last sentence where I said that government and funders have to leverage the strength of those clusters. Cooperative societies are another critical cluster of or enablers that we need to be partnering with. We need to strengthen them, we need to solidify them, we need to support them, and we need to partner with them, so that, because they know their members more, their members trust them, they provide loans to their members. Now, their loans are so you need to understand how cooperatives work. Cooperatives are able to give you lower interest loans because it is your own money. You are the one putting the money together, so the cost of capital is low. So you are the one putting the money, saving the money. Oftentimes you have to save for at least 6 months before you start getting you are qualified for a loan. And because you know that it's your money that you are putting together and those of your other colleagues, the motivation to default is also very low. And there are other benefits. The cooperative also puts money together to do things for their members, like house cooperatives that have housing schemes and a few other things. So yes, should we be strengthening them? Yes. Should we be encouraging them? Yes. Should we have more of such? Yes. And those are the only ways that you can make significant progress because of the nature of SMEs.
All right, let's look at the issue of licensing for microfinance banks. The CBN, has unveiled an online platform to cater for that, to make the process of application for licenses easier. What's your take on this?
So, I think that MFB micro licensing in those days used to be very easy. I think that it became quite difficult when fintechs came up, and a lot of fintechs started raising money on the back of microfinance licenses. And then the CBN woke up and was like, what's going on here? And then strengthened or tightened regulations around it. So I'm very happy that, we are now going back to relax or to increase the access to registration. I always say that licensing should not be opaque, should not be cumbersome, should not be difficult. A lot of us do businesses both in Nigeria and the US, and you see that the ones that you do abroad are just so easy. You don't even have to go there physically. You can do everything online. In Nigeria, you have to go here, you have to go there, sky this file, sky that file. So when I read that, I was quite happy that yes, hopefully things would become easier. But there's also the issue of capital, which has been increased. So barrier to entry is now a lot higher. So that's why a lot of people are now moving to the lenders licenses from the states, or microfinance or cooperative options, right? Because microfinance bank requirements in terms of capital is now way higher. But from a process standpoint, yes, I do agree, and I do I must commend the CBN for the efforts to make the process a whole lot seamless.